Hi everyone, welcome back to 2020. I'm Piers Bolger, the Chief Investment Officer here at Viridian. So we thought we'd start this year with a little bit of a look back on 2019, but more importantly, what do we think are some of the key themes as we head into 2020 for financial markets, and how we're thinking about that in regards to our portfolio positioning. Clearly 2019 was what we believe to really be an exceptional year in terms of overall market performance, whether it be in equities or in fixed income, property. All asset classes tend to do very well. So the thought process clearly for a lot of investors is, well, 2020 is going to be exactly the same. And that's not our view. We believe that certainly the performance we've seen in financial markets through 2019 is unlikely to continue at the same pace and the same rate of performance this year. And there are really four key themes from our perspective that we've been focusing on as we head into 2020. First and foremost, geopolitical issues. We've got the China trade dispute with the US that's ongoing. We've seen stage one deal being signed, but clearly there's some further developments that need to take place through the course of 2020. We've got the Brexit deal now beginning to start, but again, even though that's passed through the UK Parliament, the EU have already indicated that it's unlikely that a deal will be sort of ratified before the end of this calendar year. And then we've got the presidential election, which for us is the big one. It's unknown, obviously, who Donald Trump's going to be up against, but between Bernie Sanders, Elizabeth Warren, and Joe Biden, it's going to be very interesting as to who the Democratic nomination is going to be. And then finally, we've got what we believe to be probably the challenge for many countries, and how they'll tackle that is the weaponisation of their currencies in order for them to make them, as I said, more competitive on the trade front. So geopolitical framework is going to be quite challenging throughout the course of 2020. You then knock that on to what does that mean for our economies and economics more broadly. The US economy continues to be the bellwether economy on a global basis. Very solid performance through 2019, and that is continuing in our view through the rest of this calendar year. We don't see a recession on the horizon in the US. Growth, more broadly, global growth has continued to moderate, but it has had some level of stability. So we certainly think the outlook on the economic front remains relatively sound. Inflation remains benign, and that's particularly important when you think about the interest rate policy. So that leads us to our third theme, which is what are the central banks likely to do through the course of 2020? In our view, central banks are on hold. We're not expecting any increases in the cash rates globally through 2020. We think the Fed is probably going to sit on its hands for some period. It obviously was quite aggressive through the course of 2019, and that obviously assisted equity markets. On the flip side though, we expect the RBA to start cutting rates in its next February board meeting. We've seen obviously the impact of the drought and more recently the impact of the bushfires. And in our view, that's going to have, as I said, not only an impact in regards to economic activity, but equally consumer confidence and the like. And we think the RBA will look to start to cut rates through the course of the first half of this year. We expect 2 rate cuts through 2020 in regards to the RBA policy, and even potentially the likelihood of them introducing a QE program through the purchasing of Treasury securities, potentially in the second half of the year if the cash rates gets down to 0.25 or 1%. So it's going to be an interesting period as it relates to the RBA policy and the dynamic surrounding that. What does that then mean for financial markets? When we think about that in the context of how we're positioning our portfolios, we still believe equities, both in an absolute sense as well as on a relative basis compared to defensive asset classes, is still the best way to go for investors. We maintain an overweight position in across most of our portfolios as it relates to equities over fixed income. We think bonds, by and large, have done a phenomenal job in terms of dampening portfolio volatility, and certainly the absolute performance, as I said, through 2019 was quite solid. But we just don't see the valuation metrics stack up for bonds as they do for equities, as I said, particularly when we're expecting cash rates to remain relatively benign through the course of this year and certainly into 2021 as well. Bond yields have rallied significantly. We've seen the slight uptick over the last 3-month period. So we really just don't sort of see that rallying continue, even domestically, with the likelihood of further rate cuts. So positioning wise, We continue to like equities. We certainly have bonds there as a defensive mechanism. But equally, and as we've spoken about through the course of last year, we're maintaining a reasonable overweight to alternatives, trying to dampen some of that volatility and that equity beta in the portfolio, just given that multiples have increased. So in our view, there's sort of 4 key themes. We'll continue to talk about these themes through the course of 2020. A really interesting environment. We're heading into the reporting season domestically here in February. So again, that'll give us another good read on how corporates are thinking about not only the previous 6 months, but equally the future going forward. As always, if you've got any concerns, make sure you reach out to your financial advisor, and look forward to speaking to you next month. Bye for now.